Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 17th of July 2023, and here are the top stories for the day. Where did India's urban planning go wrong? Is online gaming headed for another shock? Has Dalal Street priced in demand woes for IT stocks? And what is gross gaming revenue? India's weather forecaster has cautioned people against visiting hill stations. From Himachal Pradesh to Uttarakhand, rains have brought several cities to a standstill and turned their hills and roads treacherous. The situation is no different in the cities of northern plains. Parts of Delhi are submerged under Yamuna water. But is it the nature which is wreaking this havoc, or are we also responsible? And it centers Amrit scheme, which was launched about 8 years ago to improve civic amenities in 500 cities, achieve its goal. Pastor Kumar answers.
Several parts of Delhi were flooded on July 14th, with certain areas of ITO and Rajghat being submerged. The Supreme Court wasn't spared either. Extreme rainfall in a short span of time in Delhi and neighbouring areas led to the overflowing Yamuna. The release of water from Haryana's Hathni Kund barrage contributed to the deluge. But these weren't the only reasons. Unmitigated development around the Yamuna, without considering the impact on the riverbed, has also led to the flooding. Speaking to a news agency, an expert said there were over 20 bridges within a 22-kilometer stretch of the river that were obstructing its flow and causing deposition of silt. While the incessant rains can be blamed on climate change, the other factor leading to this deluge is the absence of urban planning. Consider that Delhi's first drainage master plan was prepared in 1976. Even in 2023, the national capital is still operating on the same plan. In 2011, the Delhi government signed a contract with IIT Delhi for a drainage master plan. While the report was submitted in 2018, the plan was only implemented in 2021 before it was scrapped. After that, consultants were to be appointed by March 2022 to prepare a fresh plan, but that part of the process was completed only in 2023. Also, having a plan isn't always enough. The Brihan-Mumbai stormwater disposal system, aimed at overhauling Mumbai's old stormwater drainage system, was proposed after the 1985 Mumbai floods. But work finally started after the floods in 2005, when over 1,000 people lost their lives. The project involved building 8 major pumping stations. As of January 2022, at least 6 had been built, and the Brihan-Mumbai Municipal Corporation invited tenders for the appointment of a consultant for building one of the pending stations only in June this year. Ultimately, the project could end up requiring over 8 times more than the 600 crore rupee original cost. Let's take a broader look now. Amrut, a centrally sponsored scheme, has a total outlay of 1 trillion rupees, including a central assistance of 50,000 crore. Over the span of 6 years, progress has been made in the completion of water supply projects, witnessing a significant increase from 24 projects in 2017-18 to 940 projects in 2022-23. However, the onset of the pandemic impacted sewerage and septage management, resulting in a decline from 474 completed projects in 2020-21 to 382 in 2021-22. Despite a decline in the number of completed projects, there was a substantial increase in their cost within the same time frame. The cost escalated from over 680 crore rupees to almost 8,700 crore. But a subsequent recovery was displayed in the year 2022-23 with the completion of 524 projects. Similarly, for stormwater drainage, although the number of completed projects decreased from 1,755 in 2020-21 to 687 in 2022-23, the cost rose from about 990 crore rupees to over 1,400 crore during the same period. In October 2021, the Union Cabinet approved the Amrut 2.0 scheme till 2025-26 with a total indicative outlay of 2.8 trillion rupees. Against this backdrop, despite the Amrut scheme, why does India appear to be failing at urban planning, and how can it remedy this situation?
What Amrut as a program has completed, and I think what started as a journey right from JNNURM's time. It is a remarkable sort of achievement. It's a mammoth task. It's just that in India, we have started investing in our cities only in last 20-25 years. And what we are doing desperately is we are trying to build the basic infrastructure. So for stormwater drainage, we are just laying down the pipes. What has happened in India in last 20 years, and which is quite positive, which is projectification of urban infrastructure, which is a good idea to begin with, that we have to build those projects. Where India is lacking right now is in terms of interdepartmental coordination, and also in terms of coming together by various government agencies and making joint plan, integrated plans, having a very, very clear mandate of implementation. Otherwise, we'll be keep doing the same thing again and again. We'll have a lot of ad hoc projects. They might be good standalone project, but they would simply not be integrated as a system. And that's where we need to go.
India is going through rapid urbanization. Today, your rain events of 200 mm and 250 mm are falling in very short periods of time, which was not happening 5 or 10 years ago. So it's not like urban planning is failing. This is the moment for us to almost reinvent urban planning, right? And do it in the context of changing climate. This is where also, gray infrastructure, as we call it, will solve 80% of the problem. So, the stormwater drains, the sewage systems, anything we build with concrete, what's underground is gray water systems, right? But we all know that actually the capability of a wetland, right? Or, a overflow area like the floodplain of the Yamuna has way more capacity to actually absorb larger volumes of water when these flood events occur. So we have to make sure that we are maximizing these natural features. So if about 20% of the water, if we can take through nature-based solutions, and the other 80% we make sure gets implemented in the most efficient and technically correct manner, we will prepare to deal with this problem.
While urban planning is not limited to it, India must focus on flood management after a Ministry of Earth Sciences Climate Change Assessment report noted that the increased frequency of heavy rainfall had enhanced flood risk all over the country, particularly in urban India. An integrated approach towards projects and embracing the sponge city concept are the need of the hour.
Meanwhile, it's raining bad news for the online gaming industry in India. Last week, the GST Council announced a decision to levy 28% GST on full face value of online gaming, leaving the sunrise sector in a shock. And now, Revenue Secretary Sanjay Malhotra has said that TCS can be imposed on the payment service providers for online gaming. So is online gaming headed for another shock? Tariq Ahmed brings you the answer. Online gaming industry's worst fear turned into reality last week when the GST Council, in its 50th meeting, decided to levy 28% GST on online gaming where any kind of wagering is involved. And this will be applied on the total face value rather than the gross gaming revenue or GGR, which the industry had expected. Industry has called it a death blow and claimed that it will hit FDI and employment. Earlier, most of the online gaming companies have been paying a tax of 18% on the platform fee. But under the new system, the 28% GST will be applied for the entire face value of the bet.
One has to also figure out ideally what is the value of the service, because GST is a tax where on the value of service you have to pay the tax, not the value which is a betting amount, right? Typically, that should not be the case, but they have decided it in their own wisdom that no, we believe it's going to be 28% on the value of the money which is going to be put on the bets, and they will amend the act. They've also said that they will amend the act. Interestingly, later on, we did hear interviews of the government officials saying that we always believed it's going to be 28% on the full value of the bets. So this also statement has come later on. So I think it is it is very it is not good news. I will say it's absolutely not good news. I think it's a very one-sided decision, and the gaming industry has been actually working with METI, a division of the government, to ensure that the online gaming is more regulated, and people can play that game and they can actually work upon their skills as well. So there is one division of the government who is helping the online gaming industry to grow, develop, regulate it. And there is one now GST authorities who have put such a harsh rate, which actually is something like a death for this industry, I would say.
The revenue of the Indian online gaming industry was worth $2.6 billion in FY22, and it was expected to reach above $5 billion by 2025. All India Gaming Federation CEO Roland Landers claimed that this decision will potentially wipe out the entire gaming industry, with GST on deposit increasing liability up to 400 to 500%, and it will lead to lakhs of job losses. He also added that the only winners in this decision will be illegal and offshore-based gambling and betting platforms. While speaking to a national daily, Revenue Secretary Sanjay Malhotra said that some members of the GST Council pointed out that online games, when played for stakes or outcomes, have an element of betting which can be addictive, and it weighed on the minds of some of the ministers. He also said that people will use this time for more productive purposes. Malhotra told news agency PTI that the government collected just 1,700 crore rupees GST from the industry in FY23, which could have been 15,000 to 20,000 crore rupees had the tax been levied on the full value. Malhotra also clarified that the online games, when played without stakes, will continue to be taxed at 18%. When asked about the advantage that offshore gaming companies may get out of this decision, Revenue Secretary Malhotra said that the government will try to provide a level playing field to both offshore and onshore companies. And if needed, the government will look at payment channels or the provisions of TCS, that is tax collected at source. Experts pointed out that though it will not be a huge blow, the TCS will be a deterring factor. So will TCS deal another blow to online gaming?
What the Revenue Secretary has said about TCS, it could be implemented through payment gateway. But as under the GST, TCS, even in other sectors where TCS is charged, is just a small component. It's not a major component. So if tax is say 18%, TCS will not be entirely 18%. So yes, that will be a deterrent also, and I think the government will look at different avenues on how to ensure that this tax is paid before paid with the government.
Industry experts are hoping that there will be a rethink in the government corridors on 28% GST move. But if we go by the statements that have come out so far, a rethink looks unlikely. But if it happens, it will give a lifeline to the sunrise sector. The government, on the other hand, believes that the move will not affect the revenue of the gaming firms. Experts believe that 28% GST will have an irreversible impact on $2.5 billion worth of investments in the gaming industry. Moving on to markets, the June quarter earnings of Indian IT majors were muted in line with the lower expectations. However, healthy deal wins despite the overall macro weakness lifted by the IT shares. So has the street already factored in the likely weakness, and will the shares extend the recent strength? Harshita Singh brings you a report.
The June quarter is usually a strong period for Indian IT companies, but the sector's performance this year was subdued amid a global demand slowdown. This found reflection in the delayed pay hikes for the quarter by Infosys and HCL Tech. The companies, experts believe, are now looking to bring back wage hikes to optimum levels after a massive increase in the last 2 years. On the earnings front, TCS, HCL Tech, and Wipro's Q1 net profit dropped 3 to 11% sequentially, with nearly flat revenue growth due to lower client spending. But despite the weak performance, IT stocks saw strong buying on the bourses, with the Nifty IT index rallying over 6% in the last 2 sessions. This, analysts say, is on account of the demand concerns already being priced in by the street, which does not expect any further incremental impact, though a re-rating for the sector still has a long way to go, they add.
Despite the macro challenges, most of the negatives are to be priced in. So, the earnings have moderated, and the second quarter earnings could also be soft basis the commentary. So it's like the bad news is priced in, these in prices. From an earnings standpoint, what we have been highlighting is that the earnings upgrade cycle for especially for the IT sector is still not yet visible. The broader industry tailwind that the sector enjoyed after COVID is largely behind, and it is going to be a stock specific or a bottoms up approach market right now.
Moreover, improvement in the global macro environment can set off some recovery trade in the stocks, but an outperformance will be unlikely. Analyst note.
If you see the overall order booking that has been done in terms of large deals win, even for the Wipro or TCS or SCL, most of them has delivered a very strong or healthy order wins. The problem is there could be delay in the execution, and also there could be impact on the new order wins in the discretionary part of the spend. So most of this is already priced in, that is over, but the outperformance may take time for next quarter or two, depending on the situation that emerged in the US and Europe.
Thus, as global concerns could be an overhang for stocks in the short term, investors should keep a stock selective approach with a long-term view. Today, on July 17, market action will remain stock specific. Investors will keep an eye out for Q1 earnings of HDFC Bank, LTI Mindtree and Tata Elxsi, among others.
He's making plans for an early retirement. Business Standard.
Key benchmark indices and stocks of online gaming firms moved in opposite directions late last week. While markets touched a new high, the shares of most online gaming firms crashed after the GST Council levied a 28% tax on the face value of online gaming. This move caught the gaming industry off guard. It had appealed to the centre to levy the tax on gross gaming revenue and not on the face value or the total value. But what is gross gaming revenue? Raghav Agarwal explains.
Gross gaming revenue, or GGR, is the difference between the total amount wagered by the players and the total winnings distributed by the company. It is equivalent to sales or revenue for a company and does not mean profit or earnings. This is the money left with the gaming platform after paying out all the winnings. Gaming companies assess the stability of their business by calculating another metric using GGR called GGR margin. It is measured by dividing the gross gaming revenue by the total amount that was wagered by the players. A higher GGR margin suggests that the company is retaining more money out of the amount wagered. The GST Council's decision means that the tax will be levied on the total wagered amount, known as the face value. This means the gaming companies will have to pay a higher GST. The decision will hit real money games the most. In an interview with Business Standard, Revenue Secretary Sanjay Malhotra said that the decision was unanimous and will not require any review. The government will have to make an amendment to the constitution to implement the new online gaming tax regime. Malhotra said that the centre will try to get the amendment done in the upcoming monsoon session of the parliament. But before that, the council will prepare a draft of the law with the approval of the council's fitment committee. The draft rule will be circulated to states and accordingly, approval will be sought from the chairperson of the GST Council. It will then go to cabinet and finally to the parliament. Malhotra also said that the centre expects 10 times higher revenue from online gaming this year as compared to 1700 crore rupees last year. Some companies have, however, said they would challenge the GST Council's decision.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Interestingly, the Niti Aayog had recently sought a light-touch regulatory framework for the online gaming industry. Well, that's all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.